Everyone loves a boogeyman, a scapegoat, something to blame. People love blaming politicians, developers, negative gearing, zoning, immigrants, but that's easy. Something as monumental as Australia's housing crisis, though, requires something a bit more cohesive, collective, introspective. It requires you, me, our friends, our family. And little in terms of introspection has made it to mainstream discourse on housing. The Australian economy for the past decade or so has been dominated by two key factions, and they're starting to join together. It's not mining, it's not agriculture, it's not the Americans, it's not the Chinese. These two factions are instead homegrown Aussie products, that being property and superannuation. Now, you might go, well, hold on, out of Australia's $2.6 trillion GDP, that being economic output, property only contributes about 10%. Superannuation, it's even worse, at 1.5%. So this video will be about laying a bit of that groundwork and then primarily looking at property, how it came to be so influential and indeed hegemonic. In part 2, we will look at superannuation and then how the two are beginning to interact and even coalesce. If you've ever taken an economics class in high school or in uni, you'll know that we typically measure the economy's value in GDP. A lot of what we talk about, whether the economy is booming or in recession, depends on GDP growth. Now, to a lot of people, GDP feels like this abstract, mystical figure which looks great on paper, but doesn't reflect the real economy. So, what is GDP actually measuring? GDP tries to encapsulate the total monetary value of an economy. So theoretically, because a lot of what we do is measured in money, from work to spending to borrowing at a household to a government level, GDP should be able to measure a good amount of activity in the economy and therefore reflect how it's going. Of course, like the great economists we are not going to include unpaid domestic labor in that equation. So traditionally, to see what sectors are prevalent in and important to an economy, we look at how much they're contributing to GDP. So as mentioned before, property, for example, is 10% of Australia's $2.6 trillion GDP, and that's primarily driven through services in the property industry, as we can see here. But therein lies the issue. Western economies like Australia have transitioned away from making a lot of stuff, producing things at home, having an industrial economy, to being post-industrial. A lot of that manufacturing industry has been shipped overseas to developing economies. We can see the shift here in this graph, sectors like manufacturing flatlining throughout the 1960s and dropping off a cliff in the 1970s and 80s. And we can see a likewise explosion in services. While we can see that Australia has always been a service-based economy, we can note here below that in the 1950s, services were closely linked to manufacturing, with wholesale trade and transport supporting the production and distribution of manufactured goods. Since then, the share of distribution services has steadily fallen, consistent with the declining relative importance of manufacturing and also agriculture. In contrast, the fastest growing service industries in recent years have been business services, including financial and professional services, and social services such as health and education. But simply just moving into services isn't that lucrative, particularly back then. So the nature of wealth shifted. Instead of deriving wealth from how many goods and services you can physically produce and sell, wealth became increasingly abstract, speculative. Now wealth was in how the market evaluated the theoretical value of an asset, or in simple terms, what people think your asset might be worth if you were to sell it. And this was underpinned by what's called financialization. Financialization refers to a process where consumption, buying things, becomes predominantly fueled by borrowing, loans, the creation of credit. This means that economic activity, demand, becomes fueled by finance in what scholars have called privatized Keynesianism. The easier it is to take out a loan, the more credit that flows around in the economy, the greater effective demand there is. And this, in the short term, led to a boom in Australia.
I mean, they talk about the roaring 20s, but the roaring 80s were unbelievable. Credit growth, 20% a year in Australia for the last 3 years of the 80s. Twice the growth in the economy, pushing up the price of assets.
Love your work, PJK, but nothing bad ever happened, right?
This is a recession that Australia had to have.
Anyway, so what happened is that wealth in the economy became tied to assets which required high amounts of circulation of credit to appreciate in value, to grow in value, to increase in price. Importantly, this isn't measured in GDP. GDP measures the monetary value of activity in the economy, but it leaves out speculative assets which aren't circulating on the market, but are appreciating in value due to the creation and circulation of credit. So when we try and understand the modern economy, how class is composed in Australia, looking at traditional accounts like GDP is insufficient. While, as we mentioned, property and superannuation, for example, make up a small amount of GDP, when we consider how much money is actually tied up in these industries, which isn't measured by GDP, well, we get a very, very different story. Now, in a country of high home ownership, what do you think was the #1 asset pursued? Property ownership has been formative to Australian history. Colonisation was a process of violent enclosure of previously communally held First Nations land, awarding it over to settlers as their private property. The expansion of the colonial frontier, what later became known as the Frontier Wars and the most violent episode of genocide in Australia, was predicated upon quote-unquote protecting private property rights. Our first and most severe economic crises centered on real estate speculation. But what we know as the modern Great Australian Dream was cemented in the 1950s and 60s. Home ownership considerably jumped in this period, going from just above 50% in the 1950s to above 70% in the 1970s, where it's plateaued ever since with a slight decline in the contemporary period. And so while finance was tightly regulated throughout most of the post-war period, housing quickly became the most important asset in the country. Housing was seen as a ticket to being middle class, to having a stake in the country. That is, a responsibility for homes. Homes material, homes human, homes spiritual.
And when we talk about homes material, that sense of owning your own little bit of Australia, your own garden where you tend to your own vegetables. When we talk about homes human, the idea of raising your own family in a home. And then home spiritual, the sense of freedom, self-reliance and responsibility that comes with your own home.
Because everyone needs a house, it was encouraged to buy your house, own your property which slowly grows in value. And so eventually you have a mass of people whose well-being is largely predicated upon the performance of the housing market beyond simply the fact that they need a roof over their head. So much so that it has become indicative of well-being over an entire lifetime. 2/3 of retirees who don't own their own home are living in poverty. So can you imagine what happened when credit was much more readily available, particularly in the context of previously quote more productive industries like manufacturing going overseas? Well, people over time began to park money in housing. More and more people were able to effectively demand housing as investors, but also just as aspiring homeowners. People could borrow more for less. Banks encouraged and underpinned this behavior. Australian banks crowded our business loans towards housing loans in response to increased opportunities in strong housing markets. In perhaps more cynical terms, surplus dollars have become something of a spectre stalking the planet, running up unprecedented asset bubbles in whichever national economy has the misfortune to absorb their attention. Financialization explains in the long run why house prices, the value of real estate, has increased so dramatically, so out of reach for so many people nowadays. People point to various instrumental factors, whether it be halving the capital gains discount, negative gearing, immigration, zoning laws, but these are all short to medium run factors. Underpinning these trends, what governments do is how financialization fundamentally changed how our economy works and where wealth is. And of course, underpinning that is what Australia's most widely held asset is, that being property. Today, the total value tied up in housing is $11.5 trillion, 430% of total GDP. Household debt is 112% of GDP. At a more fundamental level though, Australian banks, the institutions which do the lending, create the credit, are both uniquely integral to the economy and reliant on excessive house price growth. Since the mid-1980s, banks have escalated their share of the financial system from 50% to 90%. The big four banks are also preponderant in the Australian share market, accounting for 25% of the ASX 200. The big four banks are also the big four shares, accounting for the 4 largest listings on the ASX. Australian banks have more mortgages on their books than any other developed country banking system. Residential mortgages account for over 60% in Australia. This means that the banks and the wider financial system are structurally dependent on high and increasing house prices. And as the Australian banks go, so goes the Australian economy. which implies the Australian economy from the household to the macro level is dependent on the price growth of housing of assets held by the majority of the population. We've even found new, innovative ways to turn assets into liquid cash for spending. Home equity loans allow you to borrow money based on the equity you've built up in your property. Reverse mortgages allow you to receive lump sum payments from the equity in your house. If you've heard the saying, too big to fail, this is the epitome of that. If housing fails, if the market crashes, we're kind of
We will replay the depression of the 1930s, only this time it will be far, far worse.
One of the most interesting mechanisms of property is, as mentioned, just how diffused, decentralized, widespread home ownership is. With the exception of the lowest income quintile of just above 40%, all income groups have between a 50 to 80% home ownership rate. Moreover, 67% of total household wealth is held in property. If we go back to our understanding of how class works explained more thoroughly here in this video, traditionally, we understand the working class as people who sell their labor power to a capitalist, a business owner, who then pays them a wage. Part of owning a business is of course owning the land, the private property where production occurs. It's an essential characteristic. But here in Australia today, the worker is also a private property owner, where what we call reproduction occurs. Today, the working class in Australia almost takes on a dual character, simultaneously selling their labor power, but accruing speculative value derived from privately owned land. This concept isn't a new one, though it's seemingly forgotten by the left today. When then Liberal opposition leader Robert Menzies proposed in 1945 that publicly built housing should be sold onto the real estate market for private consumers to purchase and own, then Labor Minister for Reconstruction John Debman stated that the then Labor government is not concerned with making the workers into little capitalists. Of course, when Menzies was later elected in 1949 and implemented policies which caused that large jump in home ownership throughout the 1950s, both Labor and the union movement were fully behind him. Even the Communist Party was on board. So this critique seemingly died with the Chifley Labor government. Let's take the largest explicitly anti-capitalist organisation in Australia, Socialist Alternative, as an example. Workers, on the other hand, don't own any means of production. They might own personal property such as a car, a phone, maybe a house. But while workers use their personal property to meet their daily needs, capitalists use their private property as capital. A house owned by a worker is just a home, but it becomes capital when owned by a real estate investor, used to generate wealth on a market. If you've been listening, you would know what's wrong with this. And look, no shade to Salt specifically, they're just the biggest org. To my knowledge, every organization has really failed to grapple with this, and that's why most organizations, prescribed housing policies are usually just a little bit more radical than the Greens. The only organization which, in my opinion, even touches on this is the Anarchist Communist Federation, which says in this very short article, this terrain usually isn't clear-cut. It's full of contradictions that shape how people act and see each other. Some workers own investment properties. Others rely on rising house prices for retirement. Union super funds pour investment money into the same property markets, pricing out their members. This means that some workers extract rent, others are crushed by it. Ignoring this doesn't make it disappear, it makes us unprepared. Every homeowner, whether they're an investor or an owner-occupier, uses their private property to generate wealth on the market. And again, it's usually an individual worker's biggest asset. Its equity both workers and retirees can turn into liquid cash or loanable funds. Another important point is that because of the financialization of real estate, more and more people who, again, increasingly rely on debt fuel consumption will expand beyond one property. 21% of households own more than just one property, or a third of homeowners. 71% of these multi-property owning households own just another property. So while the mum and dad landlord idea is aggrandized and weaponized in media for nefarious ends, there is a kernel of truth in there. The last thing I will note on the nature of class here is that there is a degree of aspiration, even amongst the propertyless. Despite becoming ever more bleak by the day, entering the housing market is still something young people are eager to achieve, and financially, as we've laid out, it's a smart move. culturally it's something Australians are very preconditioned and shaped into wanting. The culture of home ownership has long been perpetrated in both fiction and non-fiction television texts. The owner-occupier dwelling is a familiar and potent symbol of middle-class stability, the object and goal of a work ethic and the representation of upward mobility. One somewhat recent example of this was the 2019 election, where the Labor Party campaigned on abolishing negative gearing for all new properties, and it lost votes predominantly from low-income renters rather than high-income homeowners. That abolishing policies which overwhelmingly benefit the wealthy was seen and effectively framed as attacking working people is quite indicative. To try and sum it up more succinctly, Australia's most dominant wing of the ruling class of capital can't be measured in traditional accounts. Its power and position in the Australian economy can't be analysed through traditional ways of understanding class. Property in Australia isn't simply just about a small sect of agents, investors and developers which are responsible for about 10% of GDP. No, property as a hegemonic faction of Australian capitalism derives its position from how diffused and integrated it is within the working class. Owning a home isn't simply a personal item anymore. Every homeowner, whether they like it or not, are asset holders. Property is so decentralized. A clear majority of working people are property holders. A significant layer, 20%, of households own multiple properties, and this all cumulatively adds up to $11.5 trillion, 4 times total GDP. Property is 67% of total household wealth, and mortgages comprise 60% of bank lending, and banks intentionally crowd out business loans in favor of residential loans. The same banks, by the way, which make up 90% of our financial system and are the biggest shareholders of the ASX 200. Housing therefore underpins our entire economy. Banks, households, and the government are financially and politically directly incentivized to maintain excessive house price growth. This is why property is a hegemonic, dominant wing of Australian capitalism, one that remains insufficiently analysed and contended with by the left in this country. And at the risk of sounding dramatic here, probably the biggest obstacle to any sort of reformist or revolutionary politics. This has manifested politically in a number of ways. Typically, the Liberal National Coalition is thought of as the property party. Now, while home ownership doesn't actually dictate partisan preferences, but rather, as discussed, political parties will move to accommodate homeowners, the big property lobby groups more often than not put their weight behind the coalition, or at the very least, coalition policies. For example, the majority of donations from property developers go towards the Liberal Party. You'd be hard-pressed to find a developer or a real estate agent that votes Labor. Now, there are interesting internal distinctions between the interests of developers and homeowners. Developers, often through their big peak bodies like the Property Council, engage with and influence state and federal governments, whereas homeowners often have a lot more sway at the local level. It's why you get state and federal governments always trying to cut regulation, increase housing supply, make it easier and less cumbersome for developers, whereas local governments typically are much more NIMBY. Homeowners don't want their pretty little suburbs full of detached single units disturbed. They don't want increased residential and commercial density to potentially devalue their land. It's an interesting division between these different layers that is beyond this particular piece, but worth noting. Regardless of these internal divisions, the ubiquitous goal here is to perpetually increase house prices. This is why you'll get the housing minister at a federal level, for example, saying that they want sustainable house price growth. Not only because they're aware of the mess they got us in, but also because a huge voting bloc and the most powerful lobby groups at all levels of government are both incentivized but also dependent on real estate perpetually growing in prices. To quote the New South Wales Labor housing minister all the way back in 1986, it is the mortgage belt, that being suburbs with high proportions of homeowners with mortgages, that decides governments in this country these days.
Can you afford 60% of your income?
Can you afford 60% of your income for your mortgage? Well, what you need to do...
Through 89, I was very concerned because we ran the risk of alienating everyone who owned a home in Australia.
This is a recession that Australia had to have.
And because housing is diffused across the population, asset holders of real estate are very decentralized. As we mentioned, 70% of the population are homeowners. The performance of real estate markets become intertwined with the broader economy. And while it was mentioned that property elites are more likely to throw their weight behind conservative political parties, this has changed over the past few years. At both a state and federal level, Labor has become very close and amicable to the property lobby. Labor MPs are often keynote speakers at property council or Urban Development Institute conferences. They've been espousing essentially identical rhetoric around housing supply to these lobby groups and established numerous roundtables and summits which are inclusive of these lobby groups and their reporting. You can find many press releases of the Property Council, for example, just congratulating the Albanese government on matters from the Housing Australia Future Fund, expanding the First Home Buyer Grant, fast-tracking tradies, etc. The Housing Industry Association and the Property Council were of course signatories to the Albanese Labor government's landmark housing accord, which undoubtedly has shaped a lot of policy and attitudes within the government. But also lurking in that signatory list is a collection of superannuation funds and institutional investors. In part 2, we will be going over superannuation, its rise, its current dominance, the implications it has for Australian politics, and of course, where superannuation and property are beginning to join forces.